Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
So let's go back and look at our little directional butterfly. Now, a lot of people don't think about directional butterflies, but instead of just buying this put outright, this was trading for $1 the other day, we're going to go on in and do our butterfly. Have a lot less risk up front. We're buying one of the 113, selling one of the 118, buying one of the 123. The market was at 124 when we looked to do this trade. Now, when we saw it, if we did the 125 strike butterfly, that was trading for about 110 in this instance. 103, actually. It's trading for 103. Now that butterfly is trading for, now if we go a little bit directional, we lower our cost. And a lot of people might say, well, 103 to 89, that's not a lot. Well, if you're doing more than a 2 by 1 on a percentage basis, that's quite a bit. So 103 minus 89, that means that we're looking at 14 cents divided by 0.89. That's 15% difference. So on a percentage basis, you're looking at not only you're increasing your overall profit potential because you're paying 15% less when we're starting out. But there's a little tricky. We got to be right about our direction if we're going to do this. So I kind of like the concept in volatile stocks to do directional plays using butterflies, and I like to center this around where a 1 standard deviation move might be, somewhere fairly close to that. I want to make sure that it can make that move. I don't want to go much further than that. And in TradeKing, we actually have a very simple calculator that will help you figure this out. This is called well, not our options calculator. It's called our probability calculator. And if you want to look at where a 1 standard deviation move will be, it's going to move a little bit because we're starting today. Implied volatility at the money, notice we're using. You can use indexes historical, but we default to at the money because we want to use the actual marketplace line as to what they think the stock will do. And we'll go out to January, and we'll hit calculate. And this is implying, remember, this is at 120 now. When we started this little thing, it was at 125. But it's implying the market can go down by January expiration at a 25 vol. 1 standard deviation move is 111. So if we put 111 in here, and we put 129 in here, and we do a quick calculate, it's implying that 68% of the time, approximately 68% of the time between these two numbers, the probabilities at the future date of the underlying finishing between those two targets is right about there. So are we in our range? Well, yeah, I would look, if I was doing a butterfly today, because I was still bearish on it, I would want to stay within this range. Maybe this would be the strike that I would buy on the put side. I would sell 2 of the 112s or 113s and then buy 2 of the other ones. Now, here's what's really nice about these currency options, FX options, is that there's many different strikes that you can choose from. And the way we've kind of set it up here at TradeKing, you can pull up all the strikes, but this is another reason why I like butterflies in these underlyings, is that they have 1-point strikes and a lot of times even half-point strikes, so you can really define your risk. So if you were looking to do a butterfly today on these option contracts, the market's closed, so the spreads are a little wider than they normally are, but I might go out and go on the put side, because here's the puts here, and I'm in the January expiration. Telling me 31 days to expiration. I would look to go out and maybe buy this option contract, and if I wanted to have 3 points of upside, right, that means I would be selling the 114 and then go another more 114 and then buying the one, where are we going, 3 points, 117. Okay, and I would just add that to the calculator and we'd be good to go. All right, I don't want to digress too much, but that's how simple it would be to add a butterfly. And then if you wanted to trade it, you just click on this little button, have everything checked, and hit Trade Butterfly, and you'd be ready to trade your butterfly here at TradeKing. All right. So that's my directional play. Now, my favorite butterfly I like to do, I got a few minutes to get through this one, is sometimes called a skip strike or a modified butterfly. And it's really two trades combined into one. I hear a lot of people call them modified butterflies. I hate that term. I don't like it being called that because it doesn't tell me anything. I like the concept of a skip strike butterfly. So let me start from slide 1 here, and let's go through the steps of setting up a skip strike butterfly. Still going to use the Canadian. I saw that resistance up at 130, so I don't want this market to go above 130 on this. And my goal here is that I'm going to actually sell a butterfly for a credit. So it's great if it comes up, but a skip strike butterfly will let me get into this for a small credit. And that's pretty awesome to be able to sell a butterfly for a credit, but there will be additional risk. So hold on to your hats here before you think this is going to be the best trade since sliced bread. What we're going to do is actually sell a short spread to pay for the butterfly. So if I buy this butterfly and pay 23 cents for it, market's at 124, 127, 130, 132, we're on the call side. Embed the short spread brings in a bit bigger credit than the actual cost of the butterfly. But notice something here. This strike, we're buying here and we're selling there. So why even do that? So hence the term skip strike. We just skip that strike instead of entering two trades where we buy this one back and then sell this one to open, and they cancel each other out. And here's what the trade we end up with. So we end up buying the 127.50, selling the 130, buying the 135 for a net credit of 27 cents, which means we actually added additional margin to the account. Oops, that's an actual error in it. This would be 250. All right, that's what's great about doing these things on the fly, right? You can change it. So there's additional margin because there is a different credit spread that's in here, and you still got to have the margin for it. So we increase our risk a little bit by doing this spread, but because of this, we can get this whole thing done for 27 cents. Now this looks pretty impressive when you think about it. If this is what the overall butterfly will look like, we're going to buy one of the 127s. Remember the market's here, 35 days ago, put together on 12/11. We're going to sell two of these at 182, buy one at 135, net credit of 27 cents. Now our profit and loss graph, if we combine all these, looks like this. We do the first butterfly, we embed the credit spread, right? We sell that credit spread for 50 cents. Butterfly, we pay 27 cents. And now we combine it. It's awesome in that if we're wrong about the direction and it doesn't come to 130, we're still profitable on that trade. If it goes to 130, we make more than if we just did the butterfly. Why? Because we didn't pay for the butterfly. We actually brought in a net credit. But we do have additional risk, and our additional risk, it changes immensely when it goes all the way up here. But now you're talking about a very large move to get that underlying to move. So our profit and loss actually looks like this. We got the 27 cent credit if it goes down, 27.50 here, 32.77 here, down 23.25, doing the whole trade for a net credit of 27. Now, if you look at this trade and you know the market right now is at 124 and change, this trade looks wonderful, doesn't it? Well, once again, we're looking at it right at expiration. So if I'm doing this entire trade right now, here's what the profit and loss graph looks like. And I could just say to myself, well, gee, if it gets to 130, I'll just close out the trade and get out, and I'll never let it get to this range, right? Well, that's kind of tough to do. First of all, currency options trade 24 hours a day, 6 days a week. But if I'm looking at, or I should say not the options, not on the ISE, but the markets do actually trade after the ISE is closed, so that you got to be leery of that when you're doing it. But in general, if I look at this, this is at expiration, and it can be misleading.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.